A lot of companies are either laying off, talking about private companies too now. If you look at what's going on in the economy, companies that were doing, bang up business 24 months ago, not so much now. So they're letting some people go. And then I'm just finding that layoffs have been higher generally across the economy. And if you look at sectors like, I'll just take, you look at residential real estate building and that sort of thing, we're starting to get some inventory. And those people, they lay off quickly. And so we'll see if it happens that way. But then the commercial real estate side, we're getting the reverberation from those sorts of things now start to happen. And I think that's what's feeding into the economy right now. You look at all those numbers. Now, granted, they'll have some months where they bump up, but generally, they're on the downside, meaning that they're not that excited about that. They've got inflation problems they can't pass on. They've got problems with them, not being able to hire skilled people. There's a lot of things that factor into them, and small businesses right now are really in sort of a tough spot because they can't, unlike a big business, they can pass it on. They can't. It's hard for them to pass it on. But I grew up poor, so I know how to ask the right questions of people that are on call out in the hinterland. And one of the things I find out there is that if you look at all of their costs, you look at, for example, anything they buy at the grocery store, like their car insurance, their home insurance, their taxes, there's not anything they're touching right now that's not going up a lot. And their wages, while they're going up a little bit, they haven't been able to keep pace with it. And so that puts a squeeze on it. And that's why you see delinquencies on auto payments, delinquencies on credit cards going higher. These people can't make the numbers work. And I talk to a lot of people out there just to see what's happening with them. And, they're working 2 jobs or 3 jobs, but there comes to a point where you just can't make the numbers work. And I think that's where we are with those people right now. If you look at what's going on with the things that are inflating, which are most of the commodities and things along that line, and it's interesting about inflation. Once you start inflating, people just start adding on, with the assumption they can always say to the customer, well, I have to do it because my costs went up, and things just keep on multiplying. And my idea is that will have a problem for people in the lower 50% of income. I think, again, one of the problems you have in the country is that all of this the Federal Reserve has done the last 20 years has been great for people with a lot of money, but it's been horrible for everybody else. And, you've got this situation now, and I think what they've run into now, though, and you're going to see this show up, is that all of this asset appreciation, it's one thing to have your stock portfolio go up, but if all your real estate goes up, and then the smaller people trying to buy real estate, that changes that game. They have to live in a house. They don't have to live in the stock market. And so all of that fits in together, to me at least, to see what's going to happen in the future. And I just see slow growth. I mean, I can't imagine you're not going to stagflate here and maybe grow at, 1.7, 1.8, 1.9%. That's about all you're going to get. All 3 of our strategies have a very high amount of treasuries. Now, obviously, the conservative income and high income have more than the stock account. But, most of our treasuries are less than 2 years. We're getting over 5 on everything. Every time we get the 2-year up to about 5% or over, we reach out and buy a few percentage points of it so we can stay locked in on it. We haven't really bought the long maturity. I know a lot of people are thinking we want to buy the 20-year bond, like the tilt or something. But if you stop and think about it, if you're only getting 4.5, and let's say the market does move, say you move a point and you make a one-time maybe 6 or 7%, you see the risk of that, and the cash flow is not worth that move. I think Wall Street's still selling it, but I don't think that's the way to go as long as you can get the rates to where they are today, I think. Naturally, if rates go down a point, let's say that people, you're at a 5.5 Fed funds rate. Let's say the Fed funds rate goes down 1.5 points. So you go to 4% on the Fed funds. I go out and buy the 20 or 30-year treasury and I get 460, let's say, or 465. That's not enough spread for us to say, okay, we really want to do that. If rates were really high and we thought you'd get a break of 3 or 4 points, that's one thing. But where they are today, it doesn't make sense to us, at least, to do long duration. I don't think people realize, but normally your 90-day treasury is going to be around Fed funds. It won't be quite as much, but it'll be around there. And if you look at 5.5, let's say they take it down to 4, I would be okay with short paper at 4. I'd be okay with that. I think I'd be more okay with that than risking the chance that they might not go down if I buy 20 and 30-year paper. If you look at when our debt went from 17 trillion, say government debt, to now 35 or almost, foreign hasn't gone up at all, 0. So that means they still have about the same amount they had in 2017. And what that tells you is they don't want it. They don't want the paper. And there's probably a lot of reasons for that go into, I think the U.S. has made some major missteps, but that's just personal opinion with those countries. But they just don't want the paper. That's bottom line. And right now, if you look who bought paper the last 6 or 7 years, it's been our own pension funds, our own government, our own, money market fund. And that's who's bought the treasuries. Well, you get to a certain point where the old adage you learned back in business school, crowding out, really does happen. The government's getting all the money for bonds, and I think that's what we're in the process of right now. Well, if you look at what they've done over the many years I've followed them, they typically show up when times are bad. That's when they really bring the checkbook out. And I've seen them spend a lot of money when times are bad. And it's good to watch that. They tend not to buy things when everything is at the upper end. If you just look at the numbers today, for example, the S&P is 27 times, the CAPE ratio is 34 times, or price to book is like almost 3 times. Everything's really expensive, and I can see why they wouldn't want to jump in and buy a lot of things. I think if it was there, they'd spend the money. I just don't think they see the value right now. 2 of the 3 strategies, we have 50% in treasuries, and in the stock strategy, we have about 42%, maybe 42 or 43% in the short-term treasury. We're making, over 5% on it. So I'll give you a statistic just so you want to know this. If you take the S&P in December of 21, which is almost 2.5 years now, right? Take it today, okay, and go run the numbers on it. We're up about 500 points on the S&P. Throw in another 2.3 or 2.4 for the 2 years worth of dividends. You know what you end up with? You end up with about 6% return. For all these people out there in 60-40, okay? And that 6%, if I'm over here making 5.25 on a treasury, why would I want to get really aggressive to try to go get that 6? That's how we look at it from our standpoint. All of our strategies we own gold and silver, and we own, and a couple of them, we own the miners too, and we own commodities. And so those 2 things, they all fit together like that. We just think that's a better way to approach it right now. If you look at the kind of money that's been put into, there's been a lot of CapEx lowered, going into a lot of commodity bases. So we think that most all commodities will do better this next 10-year period. We gone through a long period where commodities didn't do well relative to financial assets. Just go back and pull the Bloomberg Commodity Index. It'll give you a good look at it over the last 20 years, and you'll see how it really didn't perform up with financial assets. However, now we're going into periods of where we don't have as much of everything. That's the problem. When you don't have as much, then all of a sudden the prices have to go up. And I think you're going to see that all the way around. For us, we've got a big spread. Fertilizer, food, metals, we have oil and gas, pipelines, a lot of things that fit in that category. I have to say that most everything we own in those categories you just mentioned, we own lower than where they are today. Now, new money coming in will go a little bit slower because of just what you said with higher prices. Because you'll go through periods where you have a few weeks where things get softer. I don't think you get anything major. I mean, I could see $120 maybe on gold, or 120, something where people might think, oh man, it's over, but it's really not. We think that's something that'll continue to move forward. You have to look at what they're doing overseas. They're really buying a lot of gold overseas. I think they've lost faith in the dollar, and they're like, we're going to own something else. A lot of the good people I know in that business will tell you that they'll give you a pretty good idea of what your lifting costs are in mines, and relative to where the prices are, you get an idea about that. But the other side of it is, one of the things that I think people forget is that if you are in what I consider a stagflation era, or at least an inflation era, the next 10 years, gold will stay up with that. And a lot of people use the Dow Jones to gold ratio. You look at that, and gold would still have quite a ways to go. One of the 2 things, either Dow would have to come down or gold would have to go up. And I'd probably get a little bit of both in the end. But, for us, we just use periods of it where there's usually sort of like a stock. There's periods where it will fade back. And when it does, you try to pick up some of it. So I think you have to go the energy business. What's happening in the world right now, and I know people want to go green, and I do too, but the problem is this idea that we can become electric based, it just won't work when you put the numbers to it. So I think people are underestimating energy when you look at it. I think they're underestimating metals when you look at it too. And I'm just saying the supply of metals and where they come from. A lot of these countries that we don't get along with produce a lot of metals. And so you have to start to look and see where that is as well. But if you do metals, you do fertilizer, food and fertilizer really work well in inflationary environments. You have to own them, to get to that. But there's a number of things you can own in there, and then you have to look at a company or companies that have the ability to adjust prices. That's important. And so you don't buy companies that do everything long-term contracts, because you're going to get hurt like that.